to tie back in those fees for them, right?
Mm.
So, yes, got to tie in the fees. So, thank you for that. Hello, everyone, and welcome, welcome. My name is Delilah Goodman. I am a mortgage broker with Next to Lending. Okay, so I specialize in giving home residential loans as well as commercial loans. Okay, so there's plenty of ways to get your dreams and your goals accomplished. Okay, I'm the bank. So I want to go over a quick presentation with you about one, loan programs and the options that you'll have, but also about the fees that's attached to the home buying process. Okay. And at the end of this, I'll go ahead and give my contact information so you would be able to get in contact with me or use M to get in contact with me because I am a lender that lends with her and for her clients. Okay. So let's get into the deep dive of it all. All right. Now, me, I was working as a loan officer assistant for over a year. I took 5 months to study for the exam. And in doing so, I went ahead and got licensed, and I'm here now. Okay. And I have put in a lot of work. I also work with a great team. I don't know, just want to take credit. I work with a loan processor, a pre-underwriter. I work with 395 lenders, which makes it more possible for you to actually get approved for a home loan. So that's the good thing. I specialize in conventional loan, non-QM loan, VA loan, DSCR loans, FHA loans, down payment assistance programs, and buy before you sell loans. So today I'm just going to condense down my top 3 loans that many of you guys hear about, okay, which is FHA, conventional, and VA loans, okay? And we're probably going to talk about some first-time home buying. All right, so I'll tie all that in, and then we'll end on the fees. All right. So I am licensed for Florida and Georgia, and both of those states do operate differently when talking about the closing of a home, but the gist still sticks. You can close your home between 10 and 14 days, okay, with me as your broker and with Next, on the background. But I like to give people a realistic timeline if they aren't ready, and that's between 30 days to 6 months, okay? The reason being is because if you have already been in the position where you're like, hey, I want to buy a home, and you've been preparing yourself for the last 12 to 24 months, then yes, you can come to me and you'll probably go ahead and we'll shoot out that pre-approval within 24 hours because we're able to qualify you. But if you're coming to me and you're like, hey, I'm starting to want to get into that, or getting used to the idea of buying a home, but I don't know what it takes, then I'm going to go ahead and nurture you. Okay. Me and Em are going to nurture you up until the point where you're ready. Okay. Not only just to qualify for, but you're actually ready to take on that big journey. Okay. And then we'd start you on that. Now, I want to talk to you about the home buying timeline. I give this that 30-day timeline, right? That realistic timeline where you've been already saving, or the last 6 months, you're like, okay, I don't want to rent anymore. I'm ready. I've been on my job for 2 years, or I'm a barber. I've been in business for 2 years, or hey, I'm a tattoo artist, but I make great money. Hey, I'm a landlord. I have 6 properties, but I don't actually own a home. There are cases like that where a gentleman may own a lawn service and he may have a lot of tax write-offs on his on his taxes. So it shows that he makes no income. Well, don't worry about that, because working with me, we're going to add back in the depreciation to show that you make income so that we can qualify you for a home. So there's different tactics that we work with you and on to nurture you to get to that point. Okay. So right now we're looking at that timeline. Okay. And let's say, for instance, day one, you do your initial consultation with me, and I give you 7 days to turn in your documents. It doesn't mean that I'm going to get rid of you as a client. No, but it does show me, hey, all right, 7 days. She gave me a W-2, 2 years of a W-2, or she gave me bank statements, or she gave me her paycheck stuff, or I may need all of those things actually for a residential loan. So if you can give me your documents, okay, within 7 days, I can qualify you within that first week. That first week you can spend with me. If you need to find your W-2s, oh my God, Delilah, I don't know what happened to my 1099. Oh my God, Delilah, I've only been employed for a year. I got to go. That's okay. We will work it. You don't have to worry about that. We will work it. Okay. That first week we spend together. After that first week, I'm going to go ahead and qualify you. If we have all our documents in place, I qualify you within 24 hours to 7 days. Simple. You give me your documents. I'm qualifying you. My pre-underwriter is looking at everything. I've already looked at rates. I looked at one of the lenders, the 395 lenders that we have, to see who you could possibly go with. If you have some trouble, hey, Delilah, I think I got some repossession on that. Delilah, my credit's not ready. Delilah and M, listen, I really want that home. And M's going to send you to me. She's going to say, get him qualified for me before we even look for a home, because I need to know what his budget is. I need to know how much he's putting down. I need to know, what am I walking into these sellers and telling them and negotiating with them. So M's going to bring you to me. We're going to handle all these financials in the first week. Okay. Maybe you need some more time. All right. Hey, M, he's with me in the nurture program that I have. I have a home buying program that I give completely for free every single month. Just like M, I give out newsletters for our home buyers. You'll spend some time with me. But if not, after that pre-approval is done, I'm pushing you right back to M. You go back to M after that first week. After you have your pre-approval, your little paper that says, hey, I get this much of a loan, I get $300,000 of a loan, you get to go shopping with M. On that second week, you're with M, you're picking out your house. The third week, you're picking out your house, you're making your offer. You come back over to me on the fourth week, and now we're doing closing and handover. That's it. All done. It's not that hard. Owning a home is not hard. It's just you don't know what to do because nobody's ever told you. And that's what we're here to do. So I want to go over three of those, my favorite, I would say my favorite, easiest to explain loan programs, okay? Because everybody's heard about them through the bank of some sort. If you go to the bank, you hear about, oh my God, own a home with little down and not that much per month. You've heard about, oh my God, look, they're giving away, Freddie Mac is giving away free homes through HUD.
Our Heroes program.
The Heroes program, absolutely.
Our
Hometown for Heroes program, which we have a program through Nexa that's actually better than that, because we've matched them and excelled. Okay. And I can tell you about that. But matter of fact, let me touch on that now. So the hometowns for heroes, right, are homes that us lenders, we give you money towards the closing or the down payment of your home. That's what hometowns for homes for heroes is, right? We give you, the lender gives you the max that Homes for Heroes allows is $500. $500 towards your closing or your down payment. What we do is that we give you more than that, because we can actually have a lender give you 0.5% down, which is bigger than the $500, which, because we're talking about percentages. So if we're talking about a $300,000 home, okay, 1% would be $3,000. Well, if we're giving you 0.5%, that's 1,500. We're giving you 1,500 towards your closing and down payment. If you're a first-time home buyer, you'll find lender credits for 2% of the loan amount. So there's so many lenders that we work with, okay, that one program doesn't outshine all the lenders that have so much money that they're trying to give you to get into their first-time home buyer program, So many of people mistake first-time home buyers for people that have bought a home once. But if you bought your home and you let 3 to 5 years go by, you're a first-time home buyer again. You qualify as a first-time home buyer. So if you want to go ahead and, let's say, sell your property with M, absolutely do so. And then you get another property as a first-time home buyer. You can do that depending on how many years that you've last bought your home. So I love that program because it really helps veterans. The Homes for Heroes, it helps veterans, and it allows veterans to have an option to actually one, be somewhere where they know that they're going to get help, because there's a lot of resources with Homes for Heroes, lots of resources, okay, but also the programs. Now, conventional loans, I'm going to go through a few of our programs. Well, I'm going to go over just general programs, not Nexa programs, but just general programs, okay? The first one would be conventional loan. A conventional loan is a mortgage that is not insured or guaranteed by the government, unlike FHA or VA loans. Instead, these loans follow guidelines set by Fannie Mae and Freddie Mac, the government-sponsored enterprises that purchase many mortgages from lenders. Conventional loans often offer more flexibility on property types and long-term cost savings, especially for borrowers with strong credit and stable income, right? And I'm gonna break every single part of that down. Now, the down payment options for conventional loan typically requires at least 3 to 5% down, depending on the program. Borrowers may put more down, like 10 or 30%. Who wants to put 50% down on a home? You might as well not finance. Oh, no, I'm just kidding. But really, if you're got 50% of the home, okay, that's different. But conventional, they like more down. They really, the minimum, the least amount that you're ever going to put down on a conventional is 5%. Like 5%. Some people don't put anything down just because they have a great credit score and stable income. That's completely possible that you don't put anything down on a conventional loan. But I'm going to explain to you the difference and why. Okay. Now, the reason why people put money down on a conventional loan is to reduce the monthly payments and to avoid mortgage insurance. Down payment options are more so low as 5%, but the less you put down and the lesser of 20%, you're going to have mortgage insurance. So let's say you put 10% down, you're going to have private mortgage insurance up until the loan is at 78%. And I'm going to explain that. So let's say, for instance, you put 10% down. Okay. That means that now you have 90% of your loan to pay down. But you know what you do have? You have 10% in equity. That's what you have. You have 10% in equity. Now, let's say you've paid down your loan another 10K. Okay. And you've done this through mortgage payments. Okay. The moment that you've paid down your loan to 80%, you can request to get your private mortgage insurance taken off. Okay. Now, they may take it off, they may not. But once your loan reaches 78%, you are allowed to go ahead and it automatically cancels by law. All right. So that's the biggest difference. Now it states if a borrower puts less than 20% down, the loan generally requires private mortgage insurance, PMI. PMI can be removed once the loan reaches 78% loan to value, either automatically or by law. Okay. And we want to really focus on that because this is a big factor with FHA loans. Now, the credit requirements for a conventional is usually 620. Okay, we started at 620 for conventional loans. That's when you qualify. They like to see 2 years of income, 2 years of work history. Okay, um, really stable income, really stable credit. Okay, I would say property flexibility is going to on a conventional loan can be financed. It can finance a wide range of things, not just from a primary residence, but a second home, a single family home, or a multi-unit. Let me talk about that. Okay. When it comes to a multi-unit, you can have a duplex, a quadplex. Okay. It would just be between 1 to 4, more so 2 to 4, because you have to live in one of them as a primary. Okay. So right then and there, it's duplex or quadplex. I rarely see people that have like 3 apartments. I rarely see it, but it's going to be your primary home, the one next to it that you're renting, and then 2 more. Okay. So when they say this right here, 2 to 4, they mean duplex to quadplex. All right. Now let's talk about FHA. I'm excited. Can I get a little excitement? FHA, I love because FHA helps people get into homes and they work with people. They work with people's credit. They work with people's income. An FHA loan is a government insured mortgage designed to help borrowers qualify for home ownership with lower down payments, more flexible credit standards, and higher allowable debt ratios compared with conventional financing. It's especially common with first time home buyers or borrowers with limited credit, right? Now, the down payment, look, I even put low down payment because I love. I'm going to tell you why, because we have programs that work with the FHA on top of their guidelines, right? So FHA minimum is 3.5% down with a qualifying credit score of 540. Okay. Now I want to explain this. Okay. You will be able to put 3.5%, I'm sorry, 3.5% down if you have a 580. Anything less than a 580, you're going to put 10% down. Meaning if you have a 579, if you have a 562, if you have a 540, you're going to put 10% down on that FHA loan. And that's okay because we've got help for you guys, okay, when it comes to the FHA. So you can actually get your down payments from your gifts, your mom wants to give you the down payment, you can get it from down payment assisting programs or grants or approved secondary financing, meaning loans. Okay. Now that it has flexible credit guidelines, they're more forgiving of past events like repossession, bankruptcy, as long as there has been some time in between that, which is 12 months. Okay. A lot of people are like, oh, I could never get a home. I went through repossession. I went through bankruptcy 2 years ago. Has it been 12 months? It has been. Now you qualify again. You're able to get a home. Yes, people don't know that. People think that their life is just, oh my God, I can't get a home. I don't know. I can't do nothing. No, 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 no. Come and start back over with me. Come rebuild with me. Let me give you all the information that you need to know, because if there's a will, there's a way. Okay. I never tell people no. Okay. As long as it's legal, then Delilah's going to find someone to do it. Okay. Who can we find to do it? And is it legal? Two questions that I ask. And then we're going to get it done for you. Okay. Now, I do want to say that if you do have some blemishes on your credit, FHA still works with you. They just may want to have you on certain programs. Like they might want you to get an education course through HUD. Okay. They might want you to put a little money down, or that down payment assistance may come structured as a silent second. It may come because down payment assistance, when it comes to lenders, are structured in three ways. Okay. The first one, I love Em. She's so wonderful. She's like, yeah, go on, tell me. The first one is forgivable loan, where you can be in that home and it's forgivable as long as you're there for a certain amount of time, really 3 to 5 years. The second way that it's structured is a silent second, which means that you won't have to repay that loan, that down payment assistance back, unless you're selling or refinancing your home. The third is through a secondary loan, where you would have a loan, a payment, and an interest rate tied to that payment, just like you would a credit card. And most times it's usually higher than conventional interest rates. So I don't tend to like to put people in that third one. I want to see what they're able to do. But in order to qualify for a down payment assistance program, you have to have a credit score of 620 most times, unless the lender is giving you a first time home buy program, which we have lenders in those programs as well. Okay. Now, remember when we were talking about mortgage insurance? The mortgage insurance is very imperative when it comes to your loans, because it actually dictates whether it be affordable for you or not, and how long that affordability you have to wait for it to come. Right. So with a conventional loan, if you put 20% down, you completely bypass monthly private mortgage insurance. Okay. Now, when it comes to FHA, you will have mortgage insurance premium regardless. Okay. The only way to avoid that, okay, is after 11 years. FHA, I know it's like a dum. But FHA, and this is to ensure the lenders loan to you, because again, this is to prevent the lender from having risk on the loan that they gave you. So let's say, for instance, you have a conventional loan, you put 20% down, you don't have PMI, private mortgage insurance, every single month. But when it comes to an FHA loan, you put 10% down on an FHA loan. You will have to pay mortgage insurance premium for 11 years. And that's when you may be able to get that canceled. Okay. You may be able to get that canceled. But let's say, for instance, you put on an FHA loan, you put 3.5% down, you will be paying that for the entirety of 30 years or until the loan is paid off, whichever one comes first. If you pay off the loan before 30, it's removed. If 30 years come before then, but you haven't paid off the loan, it's removed, but more so the entirety. And this makes it pretty expensive for people per month to actually have a home. Okay. Because FHA requires two types of mortgage insurance, which is the upfront mortgage insurance premium, typically financed into the loan at closing. That is due at closing. And then you have your annual mortgage insurance premium, which is paid monthly as a part of the payment. Okay. Because I'm going to tell you something. A mortgage consists of 4 to 5 things. Okay. I'm going to break that down. Okay. Your mortgage consists of 4 to 5 things. The first one being principal, interest, tax, insurance, and if applicable, HOA. Okay. That's called PITI or PITIA. That's what we call it. Principal, interest, tax, insurance, and HOA. Those five things, when you put them together, is what we call a mortgage. If you should not pay your HOA, you will get foreclosed on. Even, yes, that is very true. You will get foreclosed on if not paying an HOA. Okay. You don't pay your interest, or you just make your principal and tax, or you don't pay your insurance, they have every right to foreclose on you. Okay. And we don't want that to happen. So your insurance is very important, because if you have it, it must be paid. Okay. So, unlike conventional PMI, FHA mortgage insurance may remain for the life of the loan, depending on, the LTV at origination. LTV is your loan to value. That deals everything with your down payment. And in order to qualify you, we worry about these two things: loan to value and DTI, debt to income ratio. How much are they getting paid versus what are their expenses, right? So the I would say more, I like FHA because it helps people get into homes quicker, but I don't want people to mistake it. You can change your loan product. When you refinance, you're changing your loan product. If you have an FHA loan, in 3 years, refinance it to a conventional. Come back to me and come refinance to get a lower monthly payment. If you're working on your credit, but you want to go ahead and get that home right now because you don't want to rent anymore, get into an FHA loan with a 540, even a 520. Many of our lenders do 520 into an FHA. They do 500. We start at 500 credit profiles. You can get into a home, and in 12 months to 3 years, refinance your home into another loan product, and then set yourself up differently. If you have a home but you're tired of it, you want to get another home, then refinance your home into a DSCR, okay, where you're able to make money off of it by creating it into an investment property, and you become a landlord, okay? Because FHA, just like conventional, allows you to buy 1 to 4 unit primary residences like condominiums, and that you can even do manufactured homes through them. All right. So now we've got our VA, which is my last slide. Okay, I know it's a lot of information, guys. I know, I'm sorry. I'm not sorry. Okay, because I love to inform you. But we've got our VA loan. And a VA loan is a mortgage program backed by the U.S. Department of Veterans Affairs, designed to help eligible veterans, active duty service members, and certain surviving spouses purchase or refinance a home. The program's biggest advantages are no down payment, no monthly mortgage insurance, and flexible qualification standards. I'm going to say this to summarize the VA loan, because it's a lot of misunderstandings around it. Okay. The VA loan allows 100% financing, meaning you don't have to put a down. Okay. If you're willing to stay within certain parameters, VA loans also go all the way up to $2 million. They don't have conforming loan limits. Yeah. Because FHA, conventional, USDA, and yeah, FHA, yeah, basically Fannie Mae and Freddie Mac have conforming loan limits where, and they go by county. So for Broward County, I believe the conforming loan limit is like 865,500. As long as you're within that loan limit, you can go ahead and get a loan through Fannie Mae or Freddie Mac. Anything after that is considered a jumbo loan. Well, for the VA, it's government insured up until 2 million. Okay, we don't worry about DTI or LTV. We worry more so about your residual income. Okay, there's a lot of fees that's taken out during this process of buying a home, because I'm closing on 2 VA loans right now, and a lot of the the property taxes are don't have to get paid. Again, zero down. And that's if you're, based on your, more so there's a range that it goes by for not so much credit, but for your pay. Okay. So if you are making this much of amount, we can give you this much of a loan. But if you're making this much of an amount, we can give you this much of a loan that you are requesting, even though it's $1 million loan, you're just going to have to give me money on it. It's not that you disqualify yourself. Many people, with like a civilian loan, I have to say, no, you don't qualify for 400K. I can't give you that. But with a VA loan, I could say you qualify for 400 without a down payment. But if you want the 600 like you're looking for, you're going to have to give me 40 grand down. And that's how that kind of works. We're able to negotiate, right? So this is wonderful program. It's very different. I would like to, if anyone's interested, sit down and have a private consultation about this, because this presentation for the VA comes by itself, because again, it's a program through the veteran. See, it's actually designed through the Veteran Affairs Department. So it's technically a Freddie Mac loan. It goes by Freddie Mac guidelines. It starts at 540. Okay, you still need a credit qualification, but they're very different. They're very a league of their own, if I can say that, rightfully so, a league of their own. Shout out to our servicemen. So to tie it back in to M, let's talk about the fee worksheet associated with a real estate transaction when buying a home. Okay. Because a home loan fee worksheet is a valuable tool for potential homeowners to understand the costs associated with securing a mortgage. This document typically outlines various fees and expenses that borrowers may encounter during the loan process. These can include origination fees, appraisal fees, credit report fees, and title insurance, among others. The worksheet serves as a detailed breakdown, helping borrowers to compare loan officers from different lenders and make informed financial decisions. By listing both upfront costs and ongoing expenses such as mortgage insurance and interest rate, the worksheet provides a comprehensive view of the financial commitment involved in purchasing a home. It's essential for borrowers to review this document carefully to ensure transparency and avoid unexpected costs. Okay. So I'm about to give you an example, okay, from my archives. I'm going to give you an example from a live loan that I am actually working on. Okay. We're going to, of course, there's no private information on this paperwork, but I'm going to show you fee for fee what owning a home looks like. Okay, guys. But first, I want to break down some of the gist, right? So we're going to go by boxes. Okay. And I've already went ahead and put the letters by the boxes, of course, but we're going to go by boxes. So in box A, that's origination charges. Okay, that's the lender fees, your points, if applicable. Box B, services you cannot shop for, like your appraisal and credit related services selected by the lender. Those are things you can't shop for. You can't shop for an appraisal. Like you can't, go, I know my cousin over that does an appraisal. They don't allow it. Okay. But services that you can shop for, okay, is your title and your settlement services. Using another provider can actually change the cost. And let me tell you what I mean by this. If you're sitting in title with me, okay, you've picked the title company, this is the title company that you want to work with, and all of a sudden a week later you're like, no, I want to change the title company, you're going to lose money with the title. And the money that you put with title, okay, because they're holding your escrow, is your down payment, your binder fee. Like if you have a contract that you want to put on a home and they require that you put 1% of the loan down in a binder to go ahead and proceed to hold the home for you, you can lose that money. It's very important that you, in the process, you don't switch lenders and you don't switch title or settlement service providers, because you may lose money. You're allowed to do it, but you're going to lose your money. So you can't expect to say, I just put $5,000 down and now I can get it back. No, you cannot. I've seen that happen many of times when people switch lenders or switch title service providers. So be wary of that. But that's something you can shop for. So if you shop for it, stick with that company that you're going with. Okay. The next one is our taxes and government fees. As you can see, no one has those options. Not us, not you. We got to pay Uncle Sam. Either you're going to pay the bank or you're going to pay Uncle Sam. It's either or. Okay. As you can see, we all here where we got to pay him in this part of the process. So after that, we have our prepaids, our homeowners insurance, our prepaid interest, and certain property taxes. These are prepaids, and I'm going to tell you why you have to prepay them. The reason why you have to prepay them is for proration. Let's say, for instance, you're closing your house on the 17th or the 15th. I'm sorry, let's just say the 15th. Okay. You have to still pay the proration until you get to that first. You have to pay everything, the property taxes for the remainder of that month, the mortgage insurance, the HOA for that. But you still have to, just like you would pay your rent that you're leaving, right? You still have to prorate your mortgage. All right. So your prepaids, your homeowner's insurance is something that you're going to have to pay up front. Also, I want you to know that in a state like Florida, which we're in right now, those things are collected once a year. So what they will do, they will break that down to 1/12 every month. That means that they will take it down 1/12 every single month until they get that entire 12. that they need for their annual homeowners insurance and the renewal for the property tax, and they'll hold it in escrow. And that's where it goes, where your service, your title and service provider actually holds it. And our initial escrow payment. Funds placed into the escrow account for future tax and insurance bills. See, I just said that. That's where they'll hold it, in the escrow, okay, for future tax and insurance bills. And your escrow will pay that out, okay, to the state every single month. Now, H is others items like your optional owner's title insurance and depending on the transaction. All right. So I'm going to show you what this looks like because I know I've been talking a lot of jargon. And I don't like to teach in jargon. I want to show you hands-on what it looks like. Okay. Now, almost the same things of what I just explained to you, but this is how we get our costs. Okay. And I know you're still like, oh my God, what is she showing me? What is she showing me? A plus B plus C equals D. Okay. Oh my God. All right. But this is what it really looks like. Okay. Let's try and zoom in on here. Okay. Now, as you can see, oh yeah, okay. As you can see, this is for a single family home. Okay. And 1 to 4 units do count as single family homes.
Are you able to zoom any more?
Sure.
Quickly before you keep going. A little
Yes.
more.
I love it.
A little more. A little more.
A little more.
Really good. Does that work for you too?
Yeah, that works for
Okay.
me.
Okay.
Can everybody see? Okay, good.
Mhm.
So for a $200,000 home, okay, single family home, 30-year fixed rate. That means that the rate's not going to change. It's not going to go nowhere. It's going to stay as is. Okay. As you can see that rate, okay, that is a floating rate. And that's actually when rates were actually doing good. Rates are doing bad now. Just like M said, if you want to buy a home, now is the time to do it. Because as you can see, this was okay. I printed this out sometime yesterday, but this $200,000 loan was maybe about May, maybe April. I think this was May, April. Because look at these rates. These rates are not, this 6.1 is not what it is right now. Okay. It's not, it's yesterday when I checked, well, 2 days ago, it was 6.49 because I'm checking every single day. And then yesterday was 6.67. Yeah, which I can do better than that. Okay. We've got lenders. I can do a 5.5. I just did a refinance with 4.5. Trust me. But what I'm saying is that this is crazy. This is crazy. So with this, okay, we're going to go through some of the fees on this type of loan with this interest rate. Okay. And I want you guys to see. All right. Now, right here, this is the highest by law that a mortgage broker can make on a brokered deal, 2.75. And as you can see, it's right there. There's nothing to hide. You can see this is what we are making. The underwriter is making this. Your broker is making this, $5,400 off of a $200,000 loan. That is the cost of business. That's not something we hide. All right. If anything, I'm a little proud. So in A, we have our lender fees. Okay. And that's where we were discussing our origination fees, right?
And they're right around 6,500.
Correct. And that's the total. That total is going to be right here in that ledger right there. And then we have B, our third party fees. And it says it, services you cannot shop for. And that's going to be $7,400. And when you break that down, it's all right here. Your appraisal fee, your credit report fee. And a credit report is not an Experian. Our credit report is different than your consumer report. It's not a Credit Karma report. It is an Experian, TransUnion, and Equifax report coming in 3. We can see everything from trade lines to anything. So if you went to go see that scammer man for that trade line, we're going to know because we know we see it. This is more tied to your social and everything. So we're going to see it. And that's why I say, if you're not ready yet, come and talk to us so that we can nurture you to get ready. Okay. You've got your FHA, you've got everything here. Your FHA upfront, your mortgage insurance. And as you can see, that's $3,300. That was finance, your flood certifications. These are things that you cannot shop for. It doesn't matter. You can't shop for them. But these are things that you can. Services you can shop for. And it tells you all this. Your lender's endorsement. These are things that need to get done. These are not optional. The only option is that you can pick where you want to get it done from, but you can't pick which one of these services you can actually get or not. And then in D, this is when it said A plus B plus C equals D. This, all those things, all these fees tied and all that, now we get to calculate the breakdown, the 1/12 of it. Okay. And that's what we're looking at. First, first mortgage principal and interest is $1,193. Homeowners insurance, 150. Property tax, you got your homeowners association dues, all that is going to give you your D. Okay. Now we have our E. Taxes and other government. As you can see, we don't touch this. This has everything to do with county. County puts these here. So the county that you are moving to, that will go ahead and auto-populate within our system. They will grab that information, okay? Everything from the prepaids, the initial escrow, payment at closing, and that has more to do with your mortgage insurance premium. Look, I said 0 months. This is at 12 months. This is prepaid interest for 19 days, okay, at $32.95 per day. And, your property taxes, everything is here. Then you have your initial escrow payment at closing, okay? Everything is here as well. It's calculated. And then estimated funds to close. It's going to take all the fees that we just talked about, and it's going to say, yep, your down payment, your funds, your lender fees, your third party fees, your taxes, your everything here. And this is what's needed at closing. Oh, but hold on. You got some lender credits. Look at that. Look at that. You've got some stuff here. We'll go ahead and give some money back to you. Total credits applied, $3,300. Okay. And this is going to be your initial fees worksheet. These are the fees that's tied to you actually owning a home. Okay. And this is what we would send you when dealing with your loan estimate. Even if you said, hey, with that pre-approval, can you send me my fee worksheet? Absolutely. Okay. So this is what that looks like, your loan estimate before choosing a loan. Your actual rate, payment, and cost could be higher, okay? Because this is a floating rate. This rate hasn't been locked yet. So this is a floating rate, okay? And that's what the fees look like when we're in the home process and the home buying process and we're actually closing, okay? And that is my part of my presentation. And thank you, Em, for the opportunity. Thank you. Thank you.
You are welcome. You are welcome. You done taught me something. So I love that. I really love that. So I appreciate you spending your Saturday morning here with me.
No problem.
That's just perfect. And so, like I said, I believe that people need education, especially in real estate and home buying, so that they can know what their options are for making the move from renting over to home ownership. And so I decided to do the Savvy Shopper series this year. That's what we have going on right now. At the beginning, we did some market stats for the Orlando, Orange County area. I would invite you guys to send over either like a message or a comment if you have any questions about anything that Delilah previously shared with us. Then put your questions into the comment section so that we can get your questions answered at the end of this. If you are interested in reaching out to her directly or anything like that, let me know so I can put you guys in contact with one another. And then yes, most importantly though, if you have any questions about any of the information that's being presented, we do have a Q&A session at the end of our webinar where we invite people to put their questions and we're going to answer your questions for you. If you'd like to, Miss Delilah is about that. So if you'd like
I really am.
Say like, well, Miss Delilah, hypothetically, if I have a friend who, has this, and this going on, what would that look like for their payments? Then I would invite you to do that too. You don't got to put all your business out there, what you're comfortable sharing. But if you'd like to know like what you might qualify for, what you monthly payments might be, then with different loan programs, that's a scenario that Delilah can definitely run for you. And so we can see this presentation here. All set? Yes?
Yes.
Okay, great. And so we're here with the Savvy Shopper series. We just went over the home loan options that you have. The real estate topic for this month is real estate commission, how real estate commission is calculated, how much you might expect to pay for working with an agent. I always like to tell people that like, If you want to buy a house on your own, you can buy a house on your own. But it's more like, if I want to do my own taxes, I can do my own taxes. I'm a smart girl. I can read, I can put things together, I can figure it out. But I don't do that. I have a tax preparer that I trust, that I know that they know what they're doing. And I basically say, this is going to be yours to handle. You could do it on your own, but it's better to work with a real estate agent. It's better to work with someone who is a professional in that industry so that they can guide you appropriately. And so what would that look like for paying your real estate agent? No one works for free. Everything that we do is going to have a dollar amount that goes with it. So our topic for today is going to be about real estate commissions, how it's calculated, who pays the commission, when it's owed, when it's due, etc., so that you can buy with confidence. Before we get into that, I'd like to introduce myself. My name is Manesse DeLeon. I'm a real estate agent. I'm local to the Orange County, Orlando area. And I was raised on hard work and follow through. I found that it's served me really well in life. As a real estate professional, I pride myself on being personable, professional, and detail oriented. My goal is to use my skills, my network of connections, and my industry expertise to help you actualize your dreams of home ownership. This is my son. His name is Tafari. He's 4 years old right now. He loves reading. He doesn't love Paw Patrol. He loved Paw Patrol when I made this presentation, but he's more onto like Sonic the Hedgehog and Teenage Mutant Ninja Turtles. Recently, he like balled himself into a ball and said that he was a wrecking ball, and he's just been bouncing off the walls, right? But I want him to travel. I want him to experience different people, different cultures, and I want to mold his beautiful brain with experiences that are going to build him up and make him well prepared for the world. This is the reason that I'm in real estate. This is the reason that I do what I do in real estate. And so I'm going to show y'all how the commission portion works for working with me. A little bit about me. I find that I want to be knowledgeable. If you were here at the beginning of the live, then you saw the monthly market watch update that I had and that I reviewed. So I'm always studying market trends, financing options, and local developments. I do a lot of the hard work up front for you to help you make an informed decision. My goal is to provide you with information so that you trust yourself in the decisions that you're making. I believe in honest communication. I am open. I'm open, I'm transparent, I'm here to listen and to guide you and to keep you up to date with what is happening throughout the transaction, what's happening in the market, so that you always feel informed and empowered to make the best decision for you. My goal is to make sure that you feel confident and supported every step of the way. And what you'll find is that I am dedicated. I'm loyal. From the first conversation to the closing table and even past the closing table, I am committed to seeing it through. My dedication means that I'm going to call you when I said I'm going to call you. I'm going to show up when I said I was going to show up, and I'm not going to leave you hanging. I'm going to be your real estate advocate that always goes the extra mile to make sure that your experience is as smooth and as rewarding as possible. Today, we're talking about commission. If you don't know if you don't leave this room, if you don't leave today with anything else, this is what you need to know about commission. Commission, real estate commission, is always negotiable. That is number one. It's always negotiable. There is no industry standard. There is no set price. There is no one that tells a real estate agent how much they have to charge for their services. Not NAR, which is the National Association of Realtors, not the state government, not their broker, not the real estate commission here in Florida. There is no one that tells an agent what to charge for their services. Commission is always negotiable. When you get with your agent, they're going to give you a contract, the buyer broker agreement, something that says, here are my obligations to you, and here are your obligations to me. I do this monthly webinar once a month. Last month, we covered buyer broker agreement, and we kind of spelled out all of the different tenants in the buyer broker agreement. And so that's up on YouTube. If you want the link, I could send that over to you so you can understand what kind of agreement it is that you're signing when you're working with the real estate agent. And so once you guys sign and execute that contract and you negotiate the commission and you say, okay, I agree with how this is going to be structured and how this is going to be set up, then at that point, you guys are going to move forward. But commission is negotiable. You guys sign the contract, it's set. And then from there, commission is payable when you close on your transaction. Later in this presentation, I have an excerpt from the actual contract that details what the commission language. And so we're going to break that down so we can understand how the real estate commission is calculated, how the real estate commission is paid out, and of course, who is also going to be paying that real estate commission. But yes, commission is always negotiable. And commission is payable when you close. In order for us to kind of get our mind around how this works, I'm going to introduce the commission structure and the key players when it comes down to the commission. Number one, two key players is going to be me and you. Where it's going to be me and you. You're the buyer. You're looking to buy a real estate property. You're looking to buy a home, and I am your agent. I represent you. Just like I would be your attorney, I represent you on the real estate transaction, which means that you and I are the ones that are working together. You and I are going to sign the buyer broker agreement. We're going to agree on a price and we're going to execute it, that I'm being paid X amount of dollars for my services, X amount of percentage, X amount of dollars, whatever we agree to. But we agree that I'm working with you and this is how much I'm getting paid for the work that I do. The other key players are going to be the seller and the seller's agent. So when you are on Zillow and you're scrolling through Zillow, all those properties that you see, 98% of them are going to be listed by a listing agent. And unless they're for sale by owner, which is what it is, the house is for sale by owner, not by agent or not by brokerage, right? So those houses that you're seeing on there, they're listed with an agent. So the other people in this process is going to be the seller and the agent who represents the seller. The same way that you and I have an agreement for what I'll be paid for the services that I'm providing, the person who's selling the house, they also have an agreement and a contract for what their agent is going to be paid for their services that they're providing to the seller. What oftentimes happens is that the seller and the seller's agent will offer some sort of money, some sort of apples in a basket to say, well, if you buy our house, we'll give you this many apples in a basket. The house next door might not have any apples in the basket. The house 3 doors down might have 3 times as much apples in a basket, but they're offering something to make doing business with them more attractive. Delilah just showed us the fees and the schedules and the breakdown for what you could pay for when you're looking to buy a house. At the end of the day, I think the cash to close came up to, like, let's say maybe $25,000, let's say $20,000. In order to reduce the amount of money that you have to bring to the table to close that deal, sellers and sellers agents will offer seller concessions and they'll offer money towards your closing costs. And that's what the buyer's agent commission falls into. It's a concession that the seller is doing to make buying their property more attractive. Any amount of money that the seller or the seller's agents provide is going to reduce the amount of money that you owe at the closing table. This is a little bit abstract, so I'm going to work in some real numbers. You can pull out your calculator if you'd like, but here's what I've got. If you have a property that's $200,000, and your agent that you contract to work with is saying, okay, for this, I'm taking 5% of the purchase price. 5% of $200,000 is $10,000. They're going to be paid $10,000 for their services. If the seller is offering 5% as a buyer's agent commission, that's going to reduce the amount of money that you have to come out of pocket to pay your agent. In that case, 5% of the seller is offering 2.5% of as a buyer agent's commission. That's going to reduce the 5% that you owe. So if the seller's agent is offering 2.5%, then you would have to bring 2.5% to make up the difference. And so with numbers, the seller would be paying $5,000 and you would be paying $5,000. If the seller is offering 3%, 3% of $200,000 is $6,000. So instead of you having to pay $10,000, the seller is giving you $6,000 of that. And you have to say, well, you're going to be paying the rest of the difference, which is $4,000. You have to say, well, is that something that I want to do before you go ahead and sign that contract and say, I'm going to move forward with this property, right? And so when you're looking at the buyer broker agreement that you're going to sign with your real estate agent to say that you're going to be working together, it's going to have a section on compensation. This is that section on compensation. And here's what it says. Broker's compensation is earned when during the terms of the agreement, extensions, renewals, during the terms of the agreement, the consumer or any person acting on behalf of the consumer contracts to acquire real property as specified in the agreement. And so oftentimes with the buyer broker agreement, you tell what kind of property you're looking for. I'm looking for residential property in Florida. I'm looking for commercial property in Orlando. So as long as you contract to acquire real property, the commission is considered earned at that point, which means that when you contract to acquire real property, you have a sales contract. You signed an offer. You put in an offer, something along those lines. And so you contract to move forward with, what is this? I have no idea what's going on here. Anyways, you contract to move forward with real property. That's the first part of the compensation section. The next part goes on to say that compensation for broker services for consumers, where's real property? This compensation is for broker services for consumer. That's a big deal. These are the things that I'm doing for you. The compensation is for broker services to the consumer. These are the things that I'm doing for you as your agent. The last part says compensation received by broker, if any, from an owner or owner's broker. That's going to be the property owner, the seller, the person who's selling their property, or the owner's broker. That's going to be, again, the seller. They're selling the property. They currently own the property. So compensation received by broker, if any, from an owner or owner's broker for services rendered to the consumer will reduce any amount owed by consumer per this paragraph, which is what I explained a little bit earlier. The amount in writing can be reduced by the amount offered by the seller or the seller's agent. That's what that part of the contract is saying. So if the seller offers any money, it reduces the amount that you, the buyer, are responsible for. That's what's happening with this part of the contract. And so the second part of the contract details how commission is calculated. The first part details who pays the commission. It's going to be the seller and the buyer, depending on how much money the seller is willing to contribute, all, some, or none. That is who pays the commission, when the commission is due, and also how the commission is calculated is going to be in the second section. This is detailing how the commission is calculated in the event of a purchase or an exchange. You're buying a house, that's a purchase. Sometimes people do like, what's it called? 301B exchange, or they do an exchange type program where they're trading the value of one property for the value of another instead of actually purchasing it with money. And so the purchase, when you're buying a property, it can be calculated as a flat fee, or it could be calculated as a percentage of the purchase price. Subparagraph A says purchase price is a dollar amount, and you negotiate that dollar amount. That dollar amount could say $5, it could say $500, it could say $5,000, whatever it is that you're willing to put your John Hancock to and say, this is what I'm signing. That's how much you'll be held to. That's what the contract is going to say. So it could be a dollar amount, or it could be a percentage. Some people would be like, it's 5% of whatever the purchase price is. And some people will say, well, I don't care how expensive the house is that I'm buying. I'm only going to pay you $10,000, something along those lines, right? So the way they have it set up is it could be a flat fee or it could be a percentage. Additionally, they could tax on like a little administrative fee. Some people will charge for like the cost of doing business. And so that'd be like your transaction fee, your admin fee. And so they'll add that on, but it has to be spelled out in the contract that they are in fact adding it on, and it has to be spelled out how much. So it could be 5% of the purchase price plus $500, or it could be $5,000 plus $500. But if they're going to do that plus, they have to let you know. They have to spell it out how much it is, and that part is negotiable as well. Next thing to know is that the fee commission is earned when you enter into the contract, and it's payable on the day of closing. After you agree to how much money it is that you're going to be paid, it says right after that that it's payable no later than the date of closing that's specified in the sales contract. So even though you've earned your money up front, it's not, that invoice is not due until closing day. It's all going to be wrapped up in closing. Even Miss Delilah, when she does her things ahead of time, a lot of that is going to be paid out at closing. And that's why you have to bring cash to the closing table. That is in the event of a purchase or exchange. The next one is going to be in the event of a lease. Some people will utilize a real estate agent to help them find a place to lease, especially if they're moving from far away, moving from Canada to the United States, moving down from New York down here to Florida. You can utilize a real estate agent to help you find a place near your job, near your school, on the beach that you're looking to move because you don't know that area that well, right? And so they have stipulations for what a contract would look like if you're using a realtor to help you lease a property. It's similar, but there are more variables because this one here depends on the number of months rent. So I'm going to keep it simple. You can do a flat fee, again, $500, $1,000, $1,500, a flat fee, so that no matter what your rental amount comes out to be, you know, I'm paying my agent this amount of money, a flat fee. And you can do it plus the admin fee or minus the admin fee, but flat fee is one option. You could also do X percentage of Y amounts rent. So you could do 100% of 1 month's rent. You could do 50% of 5 months rent. You could do whatever combination of numbers is going to work out to. So that's why they said, like, number one, commission is always negotiable. And two, it's always going to depend on what numbers you guys are able to negotiate. So 100% of 1 month's rent. If you're moving to the Orlando area, you're looking for a nice place, let's just say the rent, $1,800. You're going to pay your realtor $1,800 at 100% of 1 month's rent. If you think that's fair, you go ahead and sign that contract. If you're like, no, I don't want to pay that much amount of money, what about 50% of 1 month's rent? You would negotiate like the percentage. Or you can say, well, my realtor is actually super great, girl. How about you get 100% of 2 months rent? Some people will even do like the gross value of the lease. And so, for example, if you enter into a lease for 2 years, that would be 24 months. And so you could possibly negotiate like 0.5% of 24 months rent, because that's going to be like the gross value of the entire lease, right? And so again, you can do that with or without the admin fee, the transaction admin fee. They also have payment commission spelled out for if you were to do a rent to own. You use a real estate agent to help you find a property for rent to own. There's a lot of things that's being said about rent to own. It's always hard to find. That's going to be the first thing. And it's going to be hard to find. And when using a real estate agent for finding your rent to own, in that case, the amount owed to the realtor is going to be on the purchase price of the property, not the monthly lease amount. There's a lot that goes into like rent to own. I could do a whole presentation on that. But when it comes down to a lease purchase, where you're going to say, I'm going to rent for 2 years, and then at the end of 2 years, I'm going to pay you $300,000 for this house, your realtor is not being paid on the 24 months that you are leasing the property. They're going to be paid on the $300,000 that you are promising to buy this house for in 2 years. And as far as I understand, they're not waiting the 2 years for the payment. They're going to get paid when that contract to lease purchase is executed. So this is the portion of the buyer broker agreement that deals with real estate commissioned, how commission is calculated, who pays the commission, and when a commission is payable, when that commission is going to be due. Here are some tips and tricks to help you when moving with real estate commission. Number one, I like to know the buyer's agent commission before I tour a home. A lot of times I will set people up and say, like, you're looking in this area for this type of house, and they're gonna get emails from me. In that case, they're gonna say, Manasseh, I really love this property at 123 Main Street. Can we go see it? I'm gonna say, yes. When are you available? Set up the time. I'm gonna call that agent and I'm gonna say, hey, I've got a buyer. They've been pre-approved by Delilah, so I know this deal's gonna close. So what's the door code for us to get in? Blah, 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 blah. Questions about the house. And by the way, how much are you guys offering to a buyer's agent? That person might say 2%, 2.5%, 3%, 4%, 5%, all the way. No. But whatever that they're offering, I'm going to write that down. When we go tour those properties, we're going to be walking around that place. We're going to be looking at it. You're going to say, wow, your search skills are really great. I never would have found this house on my own. I love it. It's so close to my job. It's going to be perfect for my kids. Boom. And I'm going to say, oh, I'm so happy that you love this property. They're asking X, Y, and Z price. The buyer's agent commission, I'll say they're not covering the buyer's agent commission, or they are covering the buyer's agent commission. Either one, because you love the property. So you need to know all the information before we move forward. I might say something like, they're covering the majority of it. Like, let's say 75% of what my fee is for purchasing this home. And so you're going to be responsible for $2,000. I'm going to give you a dollar amount. I'm not going to say like, oh, you only responsible for 0.5%. What does that really mean? 0.5% of $1 million is a lot of money. So I'm going to say you're going to be responsible for $1,000 to cover my fee, because the buyer or the seller is covering $4,000. So you only need to pay for this out of your pocket $1,000, or you only need to pay $2,000. Do you want to make an offer? Do you still want to move forward? We're not going to put in an offer, negotiate an offer, and then I'm going to say, oh, by the way, they're not paying my fee, so you owe me $6,000. You owe me $7,000. Well, if I had known that, maybe I wouldn't have picked this house. So we're not putting ourselves in that situation, right? Before we even write the offer, if you love a house that much, I'm going to have that information to say, like, this is how much they're offering. Whip out our calculators, boom, boom, boom. This is what you're going to be responsible for. If you're comfortable with that, we can go ahead and move forward. Again, know the buyer's agent commission before signing an offer. Understand what your dollar amount is going to be out of pocket for utilizing my real estate services. If you feel that, yes, they're covering enough of the fee and I can come out of my pocket $1,000 or $2,000, then we can go ahead and move forward. Know what that fee is going to be, that dollar amount is going to be before you sign an offer. And negotiate. We're going to negotiate. So even if they said that they were only going to pay 2%, when I write the offer and I'm going to put it in, I'm going to be like, well, don't you want to pay 3%? Don't you actually want to pay 3.5%? Don't you actually want to cover my whole fee? My buyer's been, like I said, my buyer's been approved by Delilah. So this deal's going to close. Don't you want to pay my whole fee so everybody can be happy? We can all go home. I'd be like, you're selling a house, bro. You're getting $100,000 profit. You could spare that extra money, right? We're always going to try to negotiate the buyer's agent commission as part of the prepaid cost, as part of the seller concession, as part of something, so we can reduce the amount of money that you have to come to the table with to close on closing day. Yeah, negotiate for full coverage. That's what I just said. Okay, some people will say, well, Manasseh, can't I just work with the seller's agent? Can't I just go to the person who's selling the house for the seller and be like, hey, I want to buy your house? Aren't I going to save money that way? Yes, you absolutely will save money that way. You can save money by working directly with the seller's agents. They will assist you with writing the contract, negotiating the contract, taking it to the title company. They're going to help you get that property under contract, get it pending. But the seller's agent is working in the best interest of the seller, because that's who they're obligated to work in the best interest of. They have a contract with the owner. They have an agreement with the owner that they're providing X, Y, and Z services for a fee. So the seller's agent is going to write the offer. They're going to help you execute that contract. But are they going to negotiate? Are they going to tell you that the seller is offering X amount of money? No, they're not, because that's not in the best interest of the seller. They can, it's available in the pot, but you didn't ask for it. So why would I just give it up? Why would I just give it to you? They're not there to advise you. They're not there to help you. They're there to help the deal. They're there to help the transaction. They are not working in your best interest. You don't pay them when you work with the seller's agent because they're not working for you. They're working for the seller. So you, at that point, you're going to be self-represented. You're going to have to coordinate your own homeowner's insurance. You're going to have to coordinate your own home inspection. And at that point, they're going to ask you, well, how many days do you want for your due diligence? And what are you going to tell them? 3? And then you're going to be like, that might be enough time. And at that point, you don't know what you don't know. So you don't know that's not really going to be enough time for you to get a home inspection to come in there, but you've already signed that contract. Whatever you tell them, they're going to write the offer for because they're there to help the seller, but you are going to be self-represented. And so to summarize this portion of this commission webinar, commission is negotiable and it's never set by a third party. Whoever is running their real estate business, they're deciding how much they want to be paid for their services. Commission is earned when you submit an offer for real property, when you go under contract. Commission is due when you close on that contract, when you actually are going to be taking possession, when you close and you finalize the deal. Everybody gets paid out. That's when you close. All or part of the commission that you're responsible for your agent can be paid by the seller or the seller's broker, depending on how much they're offering and depending on how much you can negotiate that for. This is what you need to know about working with the real estate agent and real estate commission. Thank you so much for your time. I, at this time, would like to go back and see if there are any questions in our community chat. I can take this off the screen and get back to this beautiful Delilah there. Stop presenting.
Thank you.
Yes, we did good. I'm going to go and look and see if there are any questions in here. If you have any questions, now would be the time to put your questions in the chat. Okay, if you're trying to figure out how much you might get approved for, if you have any questions about how commission is explained or anything, let us know. Okay, perfect. We got some comments out here on Facebook from Miss Larissa, one of the best educators. She knows what she's talking about. She's talking about Miss Delilah. Love that. Love that.
Thank you.
And that tagged one of her friends. So that's perfect. Love it, love it,
love that. Thank you. Share it, spread the word. Yes, we're trying to educate you. You don't know what you don't know, like Em said, and there's a lot that you don't know. So talk to us. Bring someone else in. Bring in your friend. That may have, like you said, you don't want to give out too much information, but bring in the scenario. Sit down and have a meeting with them. We can have a meeting together, all 3 of us. I love to keep my realtors in all of their clients' files. So the moment that you make a meeting with me, or when you get that pre-approval, your realtor gets the pre-approval too. It just, I work like that. I want to keep it as a team, because your realtor, even if you're like, hey, I'm not knowing or agreeing what's going on with my realtor. Okay, well, let's bring it back to the table to understand what you're not understanding, because what you may want isn't something you actually qualify for. And your realtor may be the first protector to be like, hey, we can't go see that house. It's outside your budget. Like, it will kill you. Plus, it's not on the paper from Delilah. So don't beat your realtors up, so work with them because they're really there to help you. So great presentation. I even learned something. I was looking at it like, oh, okay. Like, I didn't know the self-representation part. And that was great to know. Like, oh man, definitely.
I had someone said that this is awesome. So we got some love and encouragement out there. So yes, I would encourage you to take down Miss Delilah's information for how to get in contact with her. This is going to be on YouTube in long format so that you can go back, take a look at it, watch it at your own pace. I do a monthly webinar once a month on the 3rd Saturday of the month. And so next month, we're going to be covering seller concessions, how to get the most bang for your buck, how to get the seller to come up off some of that money and help you out so you can get into your house and move into home ownership. And so, Miss Delilah, before we go, tell us what is the best way to get in contact with you. Throw out all your handles. Let us know.
Yes, ma'am. First off, I want to thank you. Thank you so much for the opportunity to be a part of your webinar. You're so delightful to work with. I'm glad that you're one of the realtors I work with, and you are truly humorous on the platforms. Like, you're so hilarious, so you get a lot of coverage. So thank you for that. Thank you.
You.
The best way to contact me is my number right there. I think it's on this side. It should be on this side,
No, you
right?
had it right the first time.
Okay.
Mhm.
Yeah. 786-431-8139. You can reach me. That is my direct cell phone number. I do pick up. Okay. My website as well. Okay. It's pretty hard, but don't worry about that. If you contact M, she will get you in contact with me. She will give you my digital card. She'll give you my Facebook. She'll give you my TikTok. She has me. So fear not. Get with M and she will get that for you. And if not, if you're still on here, my phone number is 786-431-8139. But we don't gatekeep. And no realtor that I know actually gatekeeps. No, they're here giving information. Okay. We're like, hey, pushing it down your throat. Don't worry. Get my information from M. My phone number is right here. Replay this. Save this post. Like, save this video. Okay. Trust me, you're going to want to come back to it. You're going to want to go over some things. You're going to want to look at the FHA, save the post, send it to a friend. So when they're at work, they can watch it. Just make sure that you're asking what you don't know.
Mm-hmm.
Yeah, that's how you get through me. Get to
Perfect.
me, M, or that number. Just get with M.
Okay, perfect. And so my name is Manasseh. I'm a real estate agent with Realty One Group Next Generation. I love phone calls. I could talk all day. I'll talk. I'll tell you anything you want to know. So my number is 407-906-5036. Check out my page. You'll find all my information there. I'm getting ready to shut this down, girl, so we can go ahead and get back to our Saturday. So let's end this live. Boom. That's done. Yeah, I like that, girl. Just keep waving. Just keep waving so Auntie can figure out how to end this live. Just keep waving.
Hilarious. Bye, everyone. Thank you for coming.
Perfect. Because even after I thought I was done, I really wasn't. So that's done. Let me stop the recording. Is it recording in progress?
That was so good.
Stop recording. Perfect. Wait. Now it's